Hello, I'm Breene Murphy, Director of Client Experience here at EP Wealth Advisors, and this is the EP Wealth Advisors Informed Investor Market Update. It's the week of June 29th, and we're lucky to have Adam Phillips here. He's our Director of Portfolio Strategy. He's a certified financial planner. He's a chartered financial analyst. You may have seen him in the Wall Street Journal, in Market Watch, in Bloomberg, in Cheddar. He's in the news. He's sharing his viewpoint, and we're so grateful to have Adam here with us today. Adam, thank you again for joining us. Talk to me a little bit about what you're hearing from clients that are their concerns.
Yeah, sure, Breene. So, I think one of the things that's certainly top of mind is the fact that we're seeing the number of new cases grow, where we saw a news today that about states representing 25% of the U.S. population have now scaled back their plans for reopening, either halted them altogether or making some adjustments. So that's certainly top of mind for a lot of people right now. Next, I think that has an impact on the economy and the recovery that we've been monitoring here over the last several weeks. And so certainly that's an issue for clients right now. I think the one that's starting to become more popular among clients is the fact that this election is coming up pretty quickly. It's at November. Will be here before we know it, and we are starting to see some of the early polls make some more definitive statements about potential outcomes. And so certainly clients want to know what that means for their portfolios and how we're looking at strategy going forward.
Okay, that's great. So let's unpack those a little bit, right? Like over the last couple months, we've been really fortunate enough to have a couple guests. One of which includes a pandemic policy researcher from University of Southern California, USC, and his name is Professor Lakoff, right? And one of the things that he was starting to talk about was how do countries really respond and get out of a pandemic? And one of the things that seems especially prescient right now is he really talked about this sort of this back and forth between the economy and the health of people, right? And how do you juggle that? How do you balance that? So I was really hoping that you could help us unpack that a little bit. What are you seeing, and what are your expectations going forward?
Sure, that's a loaded question. I think the first thing you obviously need to appreciate is the fact that there's a trade-off between the human cost and the economic cost. I think as leaders across the U.S. now are looking at rising cases across most of the states. I mean, it's in there. It's really up to them to impose whatever restrictions or reimpose stay-at-home orders if they think that it's needed. I think right now that's most would agree that's it's a worst case scenario. That's a last resort. But ultimately, that's what we are watching. There's the way that the metric that we're focused on right now is hospitalizations. Obviously, cases can grow. People can take the appropriate measures themselves and self quarantine.
Mm-hmm.
But when we start to see hospitalization spike, I'm thinking of Arizona, for instance, which is seeing hospital capacity, ICU bed capacity start to approach 20%.
Mm-hmm.
That's when we start to wonder, okay, how close are they to saying, this is actually causing a strain to our healthcare resources, to our medical resources. We need to impose some stronger restrictions on mobility and get this thing under control. So that's the way that we have to monitor it. Ultimately, it's up to the states, though. I think that the reality also is that it's largely, as most things are these days, that there is a political side to it also. So, it's tough, and we're watching it closely. But certainly there's an impact to the economy if we start to see a statewide mandate or local mandates to shelter in place again. But you don't even need an official response. I mean, we can see corporations, we can see households take those precautionary steps on their own. Last week we saw that Apple had already closed more than 10% of its locations around the country, and so You don't necessarily need to sit and wait around for state leaders to take action before you see an impact on the economy. So there's a lot that we need to keep an eye on.
Okay. So when you're talking about the impact on the economy, one of the things that you've shared, in previous conversations with us, in your informed investor report, in the webinars, you've really talked a lot about the unemployment, right, and looking at leading economic indicators, right. Well, right now, a lot of them haven't been, looking as good. But there's something that you mentioned in a conversation on Cheddar in an interview, about the markets that I thought was really interesting about, why the market may not be going down even though the economy is not doing particularly well. And that was around money flow. So can you tell me
Mm.
what that is, why that's important, and the fact and the role that it plays in the market behavior that we're seeing right now?
So this rebound started on March 23rd. The market through today is up about 35%. If we're looking at this S&P 500, the broad market index. Now, normally you don't see the stock market go in a straight line, and when it does, and certainly to the upside, you start to get a little bit concerned, or at least worry about potential complacency in the markets. And so,
Hmm.
for that reason, and not surprisingly, we started to hear a lot about FOMO, fear of missing out, where we've been hearing a lot about these Robinhood investors, the financial services website that caters to millennials, many first-time traders, how they were becoming very active. And so there was a lot of talk about how much influence they might be having on the stock market. Are they actually supporting this move higher? And so the conversation I was having last week on Cheddar was really about that, was really how we are looking at market sentiment right now when it appears that sentiment is quite high. The market continues to go up. The figures that I gave, and the figures that we tend to keep an eye on engaging investor sentiment, and looking out for signs that we could be in some kind of an asset bubble, are flows, are flows for investors. And so I was sharing some data, such as since this rally began on March 23rd, there's actually more money going into the bond market, into fixed income ETFs, than there has been going into stock ETFs. Another figure that I shared was that over the course of this rally over the last several weeks, we've actually seen more money moving to the sidelines. And so we have access to money market flows, so flows into money market funds or cash-like vehicles. And we see that is hovering right now at about 4.7 trillion. So that number has continued to climb, even though the market's been going higher. So that to us is a good sign. To say it another way, we'd be quite concerned if all this money was chasing this stock market rebound, and we're seeing flows out of money market funds or out of bond funds and into stocks. That would be kind of a worrying sign to us. And so we're not seeing that right now. It's part of the reason why the day after I spoke, I believe it was the day after the day that I spoke to Cheddar, it was following a 2% pullback or so in the S&P 500, and we'd seen. I think I made the comment saying that it's funny that a 2% pullback, a modest correction, can actually represent a buy the dip opportunity. We're used to something closer to 10% to actually have an opportunity. We're kind of seeing the same thing today. The market's up over 1%, no matter which index you're looking at, following last Friday's 2% pullback. Part of that is due to some good data that we saw today, but it really speaks to the fact that there's a lot of money on the sidelines waiting just for some entry point here. And I think that is going to be broadly supportive for stock prices when we do see this volatility to the downside from time to time.
Okay. Yeah, I mean, that was something that I hadn't heard and really hadn't understood till you shared it with me. So there's something else that comes out of it. So we're seeing this market that is being more stabilized by these, better flows. We're also looking at like how the Federal Reserve is playing a role, and that really gets into this idea around the elections coming up, right? Getting into like the government's role and getting us out of this, right? And so, a couple months back, you and I spoke, and we had a video on how presidential elections actually impact the markets. And I was wondering if you might, kind of synopsize that, give a better perspective, because this was something that was really, I learned a lot from you on this.
I'm smiling because I was just thinking, coming into 2020, we thought that the election was going to be the only thing we were talking about, and for a few months there, it kind of just fell to the wayside. And now we are approaching November again, and even though the coronavirus remains top of mind, as we discussed earlier, I think that you can't lose sight of the fact that we could have some type of leadership change in just a few months here, and that does have implications for the economy potentially, and for the market, at least over the short term. What we talked about, Breene, that last time around, was the fact that there's a lot of research out there that suggests that the president and who occupies the White House really doesn't have a significant long-term impact on stock market returns. And actually, there was a research report provided by Goldman Sachs, and they looked at historical returns since 1928 in various scenarios, and looking at who was occupying the White House, Democrat or Republican, who had a majority in Congress and in the Senate and the House, and just looking at the different environments. And really what they found was that there is no, what they refer to as that this R squared, this statistical significance to explain stock market returns over the long term. Said another way, the majority of the time, there are other variables that are impacting stock market returns that account for about 99% of the returns, that explain 99% of the returns. So really, the political side is really just short-term noise. Now, it is short term, and it does have a short term impact. And we from time to time we reference a slide that shows the performance of the S&P 500 immediately following Obama's election, followed by his reelection, and also Trump's election in 2016. We show all those because in each case we heard people saying if President or if Barack Obama gets elected, or if President Obama gets reelected, the stock market's going to tank. Similarly, in 2016, we heard if President Trump gets elected, the stock market's going to tank. Well, those people saying that, they were actually right for at least a little while. And over the short term, it does have an impact. But
how short term was that? I mean, I think
in Trump's case, it was really overnight. And by the time that the markets opened the next morning, the markets had actually recovered. In the case with President Obama, it was a matter of days or maybe even weeks. But the fact of the matter is, none of these cases ultimately threw off this bull market that we enjoyed for so long, that ultimately ended earlier this year. So I think it speaks again to the fact that the president does not have that large of an influence. This time around, what I am telling clients that are nervous about this is that the presidential election is going to receive the bulk of the attention. But we don't want to lose sight of what happens in Congress. It's a different scenario if say there's a leadership change in the White House, Joe Biden gets elected to the White House, but it's still a split Congress. How many of these policies can actually get done if there's still a split Congress? Now, if the Democrats sweep, it's going to be a different. It's a totally different scenario, and we acknowledge that. And I've actually, coincidentally, I've heard from 2 clients today that are nervous about this. And all I can say is that in any investing environment, there's going to be winners and losers. And a Democratic sweep scenario is no different, and it really it's on us to just position portfolios for that given environment. It's too early to make changes right now to based on what you anticipate happening. I think we saw in 2016 that you can be surprised by the outcome. So I think it's still too early to make those changes to a portfolio. But give you an example of some of the changes that might be made. If we see a Democratic sweep come November, we may want to focus more on infrastructure companies. The Democrats obviously have been trying to push towards some type of infrastructure package. Maybe that's a focus on 5G. broadening the 5G network. Maybe that's a focus on improving some of the roads, bridges, some of the hard infrastructure around the country. And so that would seem more likely to happen if we saw a Democratic sweep. And so there are ways to position a portfolio. They also might want to bring back those SALT deductions, which are now capped as a result of recent tax reform. And so what that could potentially mean is that maybe municipal bonds aren't as attractive for everybody. So there are changes that we need to make at the portfolio level, and certainly for an underlying client as well. But I think it's just so important to remember that it's not a binary. It's not a binary answer. You don't say either I'm in stocks if this outcome happens, or I'm out of stocks if this one happens. There's winners and losers, and so it's just about properly positioning.
Okay. So that's a great segue to what I really want to talk about next, which is like EP Wealth Advisors. How are we positioning portfolios right now for this changing environment to manage through this crisis? Like what are the themes to these changes too?
Yeah. So it's important that we start at the broad asset class and level. And so right now we are neutral on equities. We've been neutral since the end of last year. Before that, we had been overweight since shortly after President Trump was elected. And so we're back to neutral. And really, I think the way that I would characterize it is risks are fairly balanced, both to the upside and to the downside. Certainly, we can see this second wave or continuation of a first wave derail our economy. That's a downside risk. But at the same time, we are looking at things like ongoing Fed support, the fact that this TINA trade, as much as we're sick of talking about it, there is no alternative. The fact that stocks are actually still one of the best games in town if you need income, compared to what the yields that you're getting on treasury debt, for instance. So I think you can make a fair amount of arguments on both sides, and so that leads to our neutral allocation. Now, as I said before, there's winners and losers in any environment, and so right now what we prefer to do is make changes at the underlying sector level. So right now we're overweight sectors like industrials. We are really just looking there at increased defense spending, potentially some infrastructure spending. Later on, we've been adding to technology companies, really just looking at those types of companies who that have higher growth rates. Really, in an environment when there is no growth, you want to invest where you can find growth, and so that's a technology company. A lot of these companies, such as the software that we're using right now, that are allowing businesses to continue, to be up and running in this environment. That's where you want to be. It's just about picking your spots, and technology providers are some of the winners in this environment, and so that's where we've been adding names. And then finally, healthcare. Just looking at the focus there, not trying to pick it and get lucky on who that company is that ultimately develops, or companies that ultimately develop the treatment or vaccine for COVID-19. It's really just a broader call that the headwinds facing the sector around drug pricing, around just the political scrutiny on the sector from Washington, a lot of that has been abated and has abated, and I would say that most people are now rooting for the sector, at least during this health crisis, and so that provides a little bit of the tailwind there. Sectors that we're underweight or limiting exposure to right now are utilities, are consumer staples. So generally, these more defensive asset classes, they do provide a yield, which is great, but we're really just focusing on valuations here, and they seem a little bit rich to us.
Okay. So for the EP Wealth Advisor client, that has watched this, like, they may not have. I mean, we have a bunch of different, allocations for people. So, like, what are the questions that they should be asking their advisor? What are the things that will help, like, give them a better conversation?
I think that we focus so much on financial planning, and there's a reason for that. Our financial planning group and the tools that we use there can really show the impact that a certain investment strategy can have on a long-term financial plan. So it's important to look at one's allocation, see how that fits into their overall plan. If they need to make any changes, they can do so, and really, before actually making changes to the actual portfolio, they can run scenarios to see what kind of an impact that has on a financial plan, to see if that's a good decision or a bad one. Beyond that, if one has concerns about the current environment, maybe the rise in new cases, maybe the election that's coming up, it's important to have those conversations with their advisor. And another great benefit of the financial planning tools that we use is that you can actually run scenarios to see how a portfolio might respond in a risk-off environment, so they can actually just perhaps better handle periods of volatility. I think that's a huge benefit, and it really allows clients to hopefully avoid making drastic changes to portfolios when emotions can get the best of us.
Okay. Yeah. Thank you as always, Adam. We try to always have like a fun question. One of my favorite holidays of the year is coming up this weekend with 4th of July. So I wanted to hear, like, we're celebrating like the United States of America. Like, what is your favorite part of America?
Oh, wow. Boy, well, you can tell we don't rehearse these.
I got to keep you on your feet on this one.
You got me stumped. I mean, I got a lot of things going on in my head right now. Yeah, I guess normally I would say the ability to just go and travel and just explore all the great regions of the country, but you can't really do that right now. But so I guess for now I'll stick with some of the things I'll be enjoying this weekend is probably just some of the great food that this country has to offer, some of the great barbecue that we're known for.
Great. Adam, well, thank you very much. For all those listening, thank you for tuning in. We also wanted to let you know that Adam's quarterly Informed Investor Report will be coming out in the next little bit, probably like a week or so. Also, at the end of July or beginning of August, we don't have the dates yet, but there will be an Informed Investor Market Outlook webinar, which will be much more in depth and technical than this conversation. It's a great place to learn about like how the EP Wealth Advisors team really looks at a portfolio, evaluates the market, and may provide a little bit better context for the portfolio that you have. So thank you all for tuning in. Feel free to subscribe on the blog or on YouTube, and we hope you have a great day and happy 4th of July. All right. Thank you.